Good morning. I'm Tim Nyland. Today we wrap up our third and final installment of our 2022 Market Strategy Series by looking at the price and earnings trends for the broader S&P 500. We're going to strip the market cap bias out of the S&P 500 and draw forecast growth conclusions relative to the S&P 600. We're also going to look at both the Zacks and S&P sectors as well as the Earnings Certain portfolio strategy to see how we are positioned for growth heading into 2022. Before we get started, please like, comment, and subscribe and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. If you'd like to do the kind of analysis you're going to see in this video, then you need to have a ZAT Portfolio Manager subscription, which includes both Zacks Advisor tools and the Zacks Research System. Let's go ahead and get started. Today, I'm going to do a 100% live webinar using the Zacks Research System for our analysis, so there will be no slide deck available for today's webinar. And we'll go ahead and start with the S&P 500. As you can see on the screen, my favorite chart, I believe I have this set to a 20-year history of the price and earnings for the S&P 500 composite ETF. This is a market-weighted composite, so it's obviously designed to mirror the S&P 500. I also want to make note that we are well into the second half of Q3 earnings season, and it is clear, as I have said before, even more clear now than ever, actually, that the theme for 2022 is in fact the normalization of earnings as we enter into the normalization phase of the economic cycle. We really need to temper our expectations for returns in 2022 relative to what we've seen over the past well, I should say since the bottom of the COVID crisis. And you'll see here in just a minute why. And what I want everybody to do is pay attention to where we're at in the recovery. And it's roughly every 3 months or so that I speak of the S&P 500 and show this price earnings chart and actually comment on our progress throughout this recovery. And what I want everyone to be aware of when we're looking at valuations, again, when we're looking at the S&P 500 or any stock for that matter, it's really important to understand that today's price is really being based on where earnings are forecast to be 1 year forward. And so visually, when this earnings line is not lagged 1 year, your eyes need to go 1 year forward. So I have a button up here I'm going to push to go ahead and lag this, and I want to make everybody aware of this, because we're going to use this lag now for every single chart that we look at. And essentially all it's going to do is it's going to pull that earnings line back 1 year to give you a visual fit for a price to year forward earnings ratio. And it's from here where we can kind of get a visual on a PE multiple expansion or contraction. So again, you can see PE multiple contraction here as the earnings line moves into the price line. So earnings line in blue, price line in blue, earnings line in orange. And as these two lines begin to move apart, that's obviously a forward EPS multiple expansion. And what I want everybody to see here is that we are still at all-time record high levels of PE multiples, really that we haven't seen since the early 2000s. And we can confirm that very quickly just by going to a price earnings chart, and you can actually see that. Okay, so we don't even need to pull that chart up. We know that the distance between these two lines being at maximum relative to the 20-year history, we're going to be looking at these relationships as we move through the charts. So the important thing to note is that we have moved through the recovery, and going into 2022 now, we're going to be going from 47% growth in earnings that we more or less experienced on a market-weighted average basis. So the market-weighted average stock in the S&P 500 is forecast to increase their EPS by 47% in 2021. Note that that's going to drop to 7%, okay, and it's going to revert back to 11% roughly in 2023. Okay, so we are expecting a re-acceleration, if you will, in 2023, but obviously, you know, this is roughly a little over 2 years forward. We're already well into 2021. So these numbers are subject to change. What I want everyone to notice about this 7% in 2022 is if you do a least squares trend fit to the S&P 500 earnings line over that same 20-year time frame, and I'll just do the click on the least squares, you get a roughly 7% annualized least squares growth rate of earnings over that time frame. So we are reverting back to normalized earnings as we move into the normalized phase of the economic cycle. Okay. Now, what I want to do is I want everybody to pay attention to this 47%, 7%, and 11%, because obviously there's a market cap bias in here, right? We already know that the top 6 names, I should say the top 5 plus Adobe, which are our ECP tilt names for our earnings certain portfolio, they constitute roughly 24% of the S&P 500. So what I like to do when I'm using and performing strategy work is I like to know where the broader market is in terms of growth, but I also like to strip out that market cap bias. And in doing so, all I need to do is switch out this M for the S&P 500 to an E. And when I do that, it's going to convert us right over to an equal weighted portfolio. And the first thing I want everybody to see is how the growth rates actually bumped up. Okay. This is confirmation of a smaller cap growth bias in the S&P 500. Okay. So we've got smaller cap companies wanting to grow their underlying earnings, perhaps greater than some of our large or mega cap names. And so I want everybody to pay attention to this 45, 11%, right? So not 7%. Now we're at 11% for 2022 and 15% for 2023. So I'll toggle back to the M so you can see that market cap bias, how it drops it down to 7% and 11%. And when we strip the market cap bias out again, you can see it bumps those growth rates up to 11% and 15%. So again, we expect those small cap names to do well, obviously, in this phase of the economic cycle as they normally do. We could say the same for real estate and other sectors, at this phase in the economic cycle tend to perform well. We can get confirmation of this by simply putting the S&P 6 market cap weighted composite up here. This is the small cap S&P composite. So I'll just do the SP6M up here. And you can see, obviously, a lot more cyclical in nature, right? The smaller cap names are much more economically sensitive. That's why they tend to lead your losses into any sort of COVID sell-off. Everybody knows the damage that was done to small caps, and you can see their recovery since. But what I want everybody to notice here, obviously, we've got the earnings still lagged 1 year. So we've got a really, really solid PE multiple expansion, but you can see that it's built off of some solid growth here, 78%, 13%, and 12%. So that S&P 5E growth that we saw double digits for 2022 and 2023 is then confirmed by the broader SP6 market cap weighted composite. Notice the strength of that recovery for small cap names in 2021, that EPS actually going from up 78% forecast for 21, down to 13, and then the 12. So we're definitely getting into that more normalized phase. Keep in mind, if we do have growth scares here, and the buy side believes for a minute that this might rotate down and we might be heading into a recession, you'll obviously see a reversal in these trends, and pay attention to that. You'll see that play out as we move through over the next several years through this economic cycle. So what I want to do is I want to go back to the SP5E and talk just a little bit more. Again, 45%, 11%, 15%. This is the S&P 500 without the market cap bias. We can see that nice smooth trajectory. And again, the S&P 500, I prefer to use my own standard industrial portfolio, which is actually similar to the S&P 500, but I exclude a lot of what I call our tilt sectors. My standard industrial portfolio is a lot cleaner. I've gotten rid of companies that have been through major poolings of interest, discontinued type operations, anything that would skew financial metrics, accounting convention changes, stuff like that. And I've also eliminated all of the financials, commodity names, energy, precious metal names, and it's part of the earnings certain family of model portfolios. This is where the earnings certain family starts. So what I want everybody to see is that the standard industrial portfolio, that 400 names, this is the portfolio that I like to refer to as the pulse of the U.S. economy. specifically the U.S. industrial economy, right? Since I get rid of all of the energy names, all of the precious metal commodities, financial names, utilities, real estate, stuff like that. So 400 stocks. The reason I like this is that I split this group into an even 200 growth names and an even 200 cyclical names. Okay, and so from a strategy perspective, this is really important. If we're going to actually look at these trends going into 2022 in terms of price response and actual underlying earnings growth, it's good to have a good handle on what's actually going on underneath the hood, specifically with where we're at in the actual economic cycle itself, and we can actually see that with the cyclical portfolio. But before we move on, what I want everyone to see is how well the Zacks Standard Industrial Portfolio, again, this is the very first model portfolio. It's available in Advisor Tools as an equity select list. And you can actually see that up here under Zacks Research Equity Select List. It's right here, the Standard Industrial Portfolio. Everyone who subscribes to Advisor Tools has access to that. And it's, again, 400 stocks, 48% growth for 2021, 10% growth for 2022, and 15% growth for 2023. The significance of this portfolio is it's equal weighted in default, right? Just like the SP5E, the SP5E has 100 more stocks, but I want you to see the growth rates, how similar they are, and how well this standard industrial portfolio allows us to mirror an S&P 500 without a cap bias. And it, again, serves as that much better pulse of the U.S. industrial economy. Look at how close those growth rates are, 45, 11, 15. And again, I'll toggle back to the standard industrial portfolio. So keep your eyes on those growth rates, 45, 11, 15. Now we go to 48, 10, 15. They're almost a mirror image as well as the price and earnings action on the screen. From here, obviously, the advantage of the standard industrial proxy is that we can split this group ranked by earnings stability, both forecast and historic, into two baskets, the cyclical portfolio, which is ZCYCE, and the growth portfolio, which we'll talk about in just 1 minute. Again, these are available in Advisor Tools as well. So if I go into Advisor Tools really quick, Equity Select List, you can see the cyclical proxy. Those 200 names are available right here. Now, a lot of people would say, well, those are value names. Yes, these are basically 200 value names. And when you hear companies like Goldman Sachs and JP Morgan saying, hey, now's the time to tilt into value, and everybody's looking at each other going, well, give me a list of value names. Here's a really good list of value names you can look at. So feel free to reference those. So the main takeaway here is I want everybody to see the depth of this trough in earnings that these value or these cyclical names have basically dug themselves out of. 95% growth, right? Normalizing out to 8% and then forecast for a rebound to 12% in 2023. This is an absolutely enormous recovery, right? And the reason I love the cyclical portfolio itself is that it does a great job of exacerbating those economic cycles, specifically the earnings troughs that tend to happen throughout those economic cycles. And what I want everybody to see here is the fact that we've already priced in another leg up in the cyclical portfolio. So these stocks are getting very, very expensive, and we have growth that's more or less normalizing, okay? Now, that doesn't mean that we can't carry a multiple expansion for years on end, right? We've seen that. Look at 2013, look at 14, we actually had growth declining and we had a multiple expansion that was sustained. It wasn't until 2015 that we got a contraction, and that was actually on increase in earnings. And so the distance between the price line and the orange line, you can see the earnings, the distance basically stayed the same. So we were able to sustain that multiple expansion for many, many years, okay? So it is possible. We just need to keep our eyes on these growth rates, all right? That's the real key. I'm going to give you some really, really good materials here in just a minute for doing that, and we'll take it from there. But let's look at the growth portfolio first, okay? So the growth portfolio, and again, I want everybody to keep their eyes focused on the 95%, the 8%, and the 12%. When we start looking at the growth portfolio, and we look at our prospects for returns and growth next year. So you can see that we didn't have that earnings trough, okay? And for 2021, the percentage change, 26%, 11%, 14%. And this is a PE multiple expansion, right? You can see that the distance between the blue line, which is price, and earnings line, it just keeps getting larger, right? And remember, from webinars, and I speak of this probably once a month in at least one of our webinars, that this is primarily due to that phenomenon called equity risk premium, or the fact that right now equity risk premium is literally sitting at all-time lows. And I've actually got my 1 to 4 panel chart. I'll just pull it up here. I didn't actually plan on showing this today, but I'll go ahead and do it just so that you can see what's going on with the growth portfolio. Specifically, most of the sectors, I could literally run every S&P sector through this. They all pretty much behave the same. This is a perfect opportunity to show this. That, again, it's not necessarily the 10-year treasury yields being at all-time lows. It's really a function of this equity risk premium being at all-time lows. And this shows you that more or less inverse correlation, or that 1-to-1 mirror image between equity risk premium and PE multiples. So when people say, well, you know, the growth portfolio or growth stocks or the S&P 500 itself looks expensive, well, you can say, well, it's because equity risk premium is literally sitting at all-time lows. And you can see equity risk premium here sitting at 3.19. You know, we had the same exact PE multiples back in 2001, 2002, when equity risk premium was at the exact same level. So again, this concept of forward multiple expansion and contraction is really all about changes in the levels of equity risk premium itself. And you can see that putting the S&P 500 up here as well. So it really doesn't matter what you're looking at. This concept of equity risk premium is extremely powerful. Again, this is something that I calculate for Zacks every single week, and I encourage you to keep an eye on it. Obviously, the risk here, and I've done webinars on this as well, specifically the Lost Decade series, right? What happens when equity risk premium reverts back to the median, right? Well, these multiples would obviously be reined in. And that's probably one of the largest risks we have for 2022 and beyond, is keeping an eye on this level of equity risk premium. So taking us back to the price and earnings chart for the growth portfolio, the real risk here for the growth portfolio isn't necessarily, you know, the earnings themselves. It's what happens to equity risk premium, right? So if we get some rapid increase in equity risk premium, we could expect these PEs to be reined in, okay? But right now, I want everybody to pay attention to the fact that we only recovered 26%, right? We didn't have to recover that much. Look at the trajectory, and growth is really, really stable. 11% growth for 2022 and 14% growth for 2023. And please recall that the growth portfolio is the portfolio of 200 stocks that I draw the 75 most earnings stable names out of the growth portfolio to arrive at the earnings certain core 75 portfolio. But again, just very quickly show you the difference between that cyclical portfolio and the growth portfolio. 95% growth during this recovery to 8% to 12% versus the growth portfolio of 26%, 11%, and 14%. So what I want to comment on is, you know, this is great. So what does this mean for 2022, right? And the idea is, whenever you get these inflection points where we're coming off of this massive recovery, and then we get into this, what we call an earnings lull or a normalization period, is that we need to kind of temper and reset our expectations for returns. We need to kind of temper and reset our expectations for growth, right? Because we're literally entering a new phase of the economy, and or I should say of the economic cycle. And there's two different ways to do this, all right? I'm going to show you both ways now. The first way is the very, very easy way, and that is in Advisor Tools to just go ahead and reference a piece that Shiraz puts out each and every week. Now, keep in mind, I'm pre-recording this. It's actually Tuesday, the 9th, and Shiraz will have a new one of these on Wednesday, the 10th. You can see this is November 3rd, right? So this is actually last Wednesday's piece. But it's the sector and market earnings trend beneath market strategy. I actually use this report. I love this table specifically on page 15 and 16. So if you just scroll to 15 and 16, this is where my eyes go literally at the end of every earnings season, just to kind of get a pulse of where we're at literally a year forward, right? I keep mentioning this concept of normalization and how the market likes to look at where earnings are going to be 1 year forward. And that's what I really want you to focus on. So here's where we're at right now, play by play, as we're moving through earnings season, and we're getting close to the end for Q3. So this becomes really, really relevant. Here is the scorecard, right? So this is earnings growth year over year. And what I want everybody to see is the Zacks sectors, okay? These aren't S&P sectors, these are the Zacks sectors. And you can see the actual growth that's being forecast, not only for Q4 2021, but for the first quarter, the second quarter. And I really want you to focus on this Q3, right? Because these estimates are very well baked in right now. And the real wild card is what's going to happen the second half of next year, right? This is when we're expecting perhaps the first interest rates hike to take place from the Fed, and things could get really interesting. So when you see a non-meaningful number here, that literally just means that we're kind of crossing the negative positive growth bounds. You can see that consumer discretionary spending just literally plunged here, and you can see it recovering nicely. But what I want you to focus on, obviously, are those tilt sectors, the financials, utilities, and energy sectors. We had this massive boom, and then all of a sudden now we're getting normalization in that space as well. And these are themes that I want you to pay attention to, because when you start looking at this graphically, right, in the charts and the research system, if you're a portfolio manager's, ZAT portfolio manager subscriber, you're going to see this. And this gives you that confirmation, seeing it in a data table, that it is in fact real. Same thing with revenue growth. Okay, so on page 16, the very next page, you can see the same exact trend for revenue growth. The financials, look, I mean, let's face it, these stocks are expensive. I'm going to show you that in just a minute. We really need to see net interest margins increase. We really need to see the banks start lending. We really need to see interest rates rise and spreads to widen for these guys to start really ramping up growth. So a lot of that's already priced in, and the issue is what happens if it doesn't deliver. We're going to look at that in just a minute. But here you can actually see the energy space forecast to go negative. And keep in mind, this is year over year. So this is off a really, really strong growth of 71.6% coming off of 110 in Q2. So just keep your eyes on the base effects, and keep your eyes on these forecast changes for each of the Zacks sectors, okay? So really, really important piece. Shiraz does an absolutely wonderful job of managing this each week for us, and so you should use it. The next thing I want to show is the actual S&P sectors, okay? And to do this, I want to remind everyone that they can do a right mouse click and do a load in here. And what we're going to do is we're going to do the same thing that we did for the S&P 500 equal weight. We're going to strip the cap biases out of these things, right? And so we want to take a look at what the equal weighted average company looks like in each one of these sectors, okay? And so what I want you to see here, and I'll pull the list control down, you can see that we've got all the S&P sectors now populated in here, which is great. We can literally now just navigate through by clicking this arrow. Is this tremendous growth that's in the discretionary sector, right? We're going to go through each of the sectors. 70% growth coming off of the bottoms of the COVID crisis, right? To 27 and 20%. And one thing I do want to apologize very, very briefly. We have recession shading here that's not correct. It's going to be fixed in an upcoming release. It's already actually fixed on our dev bill. We just need to release it. But in fact, this was one of the fastest recoveries in history from a recession, and we have obviously the incorrect recession shading dates up here. So we've got that fixed, and it's going to be released very shortly. So just wanted to mention that. But the important point of this chart is that consumer discretionary space, again, this is where Amazon is, this is where Tesla is, just tremendous growth, 27%, 20%. You're going to see that for the remainder of the sectors, that's just not the case, okay? Staples, obviously, this is just one of the bellwether earnings certain sectors. And you can see that PE multiple just continues to expand, and that's largely due to that equity risk premium component. But we've got a really nice ramp up here in growth, 5%, 6%, 10% as we move through into this normalization phase. Keep in mind that we did have a little bit of a pull forward through COVID. And then so we've got some base effect taking place here over the next quarter or two, and then we start to normalize back out. Okay. Energy, right? So the big rush to buy energy stocks, you can see that the reason why, obviously, we had 1,728% increase in earnings for 2021. I want everybody to notice how important this concept of lagging the EPS is, to be able to see these relationships between price and earnings. And I've always said that, when we get into these types of really, really deep cyclical names, these prices will tend to walk that earnings line. And in fact, when you do a lag on the S&P 500 energy sector on an equal weighted basis, you can see what's happening here. So if these estimates really do come to fruition, then where are energy stocks headed, right? Are we going to get a PE multiple expansion? Well, it's very rare that we actually get a sustained multiple expansion unless we're in a trough. Okay, then we do get a sustained multiple expansion. But during these recovery phases, you can see how, back from 02 all the way up to 07, we literally just walked that earnings line. And we're doing the same exact thing now. So the idea is we need to either have energy prices increase, right? The price of oil go up, so these forecasts then rise, but then that might slow growth. Or these estimates are just flat out wrong, and there might be some potential upside. But if not, energy, has it more or less run its course? I mean, this is the analysis that we need to do. But in looking at the charts here, obviously it's not looking good for the energy sector rolling into next year. Okay, so we would need to see some sort of change in these forecast estimates. When we look at financials, it's safe to say that we've really never been this highly valued in the history of the financials, at least over the past 20 years. You could say that we had a similar PE multiple here in 07, but that was literally due to a collapse in earnings. At the same time, price was sliding. You can see here we traded at a PE multiple of 10. Note that we scale earnings by a factor of 10 in this chart. So when the blue line and the orange line touch, that's a PE multiple on forward earnings of 10. You can see that we bounced off a forward multiple of 10, walked the earnings line, and then just literally shot to the moon based on those inflation expectations that have really yet to manifest themselves in terms of earnings for banks. You can see that we've shot up 50%, but now forecast for 2022 is actually down 4%. Keep in mind, this is an equal weighted financial sector, right? So we're not cap weighting this, so there's really no biases baked into this. Okay, then a normalization out to 12%. Again, this is really going to be predicated on that net interest margin as well, as the spreads widening and interest rates going up, and the banks obviously still need to lend. We're still not seeing enough lending. Okay, so when we start looking at healthcare, again, we had a massive pull forward in earnings. You can see that acceleration in earnings, and now we're getting that little bit of a taper off the backside. Totally normal. We're not going to normalize out to about 10% in 2023. We've seen this PE multiple before, and I'm surprised it's actually not higher given where we are at in terms of equity risk premium. But keep in mind, healthcare is one of those defensive sectors, just like staples, and you can see why. Look at the earnings trajectory, right? I don't expect anything but the same for healthcare. Industrials, as we move on to the next sector here, a little bit rich, and you can see that. And so industrials need to deliver, right? I mean, the passing of the infrastructure plan was probably most of that already baked in, but you can see the forecast growth here, very similar to what we saw in the S&P 500 itself, 51% growth to 22 to 12. So a growth taper as we move through this cycle, to be expected. Okay, we start talking about IT. Information technology, obviously one of the most sensitive sectors to macroeconomic headline risk, which is that measure of equity risk premium itself. You can see a 29% recovery to 10% to 11%, so solid growth for the IT space. Again, I'm not necessarily concerned about the IT space and their ability to deliver on earnings. I'm more concerned with what happens with equity risk premium next year to determine whether we're going to continue to expand this multiple or if we're going to get some sort of valuation contraction. Okay, when we start looking at materials, again, a lot of the infrastructure play is already baked into this, and you can actually see that earnings literally going flat, 4% to 2%. So this is kind of the epitome of what we would call normalization, specifically for the materials sector, which we see this from time to time. 14, 15, and 16, we were able to sustain that PE multiple. Again, the distance between the blue and orange line. All the while, earnings were literally flat, and we're more or less getting into that time period now. So, outside of some catalyst for materials, I would expect that we would need to moderate or temper our expectations for returns out of the materials sector at large. Although there are opportunities for obviously individual names to perform well in that space. Real estate during this phase of the cycle always tends to perform well, and you can see that multiple expansion here. This is definitely acceleration, 8%, 7% to 10%. Again, I think that equity risk premium here is probably going to be the largest risk for this particular sector, but all in all, expect real estate to perform fairly consistently, as it normally does again during this phase of the economic cycle. Telecommunication services, wow, really reasonable PE ratio for 11 and 23% growth in 22 and 23. This is obviously where Facebook and Google are, as well as all your media names. 78% coming up off the recovery to 11%, and 23% is pretty impressive for the telecom sector. Utilities, this one is one that I haven't been a fan of for many years. We've got just a tremendous PE multiple off of literally lackluster growth. I mean, if the utility space in general doesn't grow at more than pretty much GDP growth every year, that's more or less what you should expect. So again, I'll just go to the valuation model. I'll throw that least squares fit on, and you can see over the past, do a history of 20 years, we're looking at literally 3.2% least squares growth for the utility space. And to be honest with you, it's just commanding a really large PE multiple. And it's literally a bid for this yield, right? This average. This is an equal weighted average yield of about 3.37%. You can see the growth here moderating back down to trend at 3%. So pop to 6, down to 3, then pop back to 7. But all in all, over the course of time, this thing is literally 3% earnings growth. So it's very expensive. Utility stocks are traditionally thought of as very defensive in nature. We didn't see that during the COVID crash. It was utilities were actually one of the worst performing sectors, and I've been warning about this for years based on this PE multiple expansion just continuing to rise. So the idea is, how much are you actually willing to pay for literally GDP growth? How much are you actually willing to pay for yield? There's probably better ways for you to create yield. So again, I wouldn't expect a whole lot out of utilities next year. Okay. So before we jump into the earnings certain portfolio part of the webinar today, I want you to check out the Zacks Focus List. It's one of our most popular equity model portfolios, and for a good reason. It gives you a list of 50 stocks positioned to beat the market over the next 6 to 12 months. And what I want to do is I just want to kind of show you where this is located. It's under the equity model portfolios, and it's at the very bottom of the list. This list is personally compiled and updated by our Director of Research, Shiraz Mian, and since it was launched in 1996, the Focus List has significantly outperformed the S&P 500. So the complete Focus List, including comprehensive Zacks analyst reports for most of the stocks, is available to all Advisor Tools subscribers as a standard add-on. To show you the value of this research, we'll give you 2 reports on stocks this week. These reports are free and there's no obligation. To learn about the 2 stocks we're picking to outperform, just follow the link in the description below, and we'll go ahead and get those emailed out to you. So let's go ahead and pop into the earnings certain portfolio, and keep in mind that we've pretty much gone through the standard industrial portfolio, right? These are the models that I manage that actually distill themselves into the earnings certain family. So it's standard industrial portfolio, 400 stocks split into an even cyclical, 200 cyclical stocks, 200 growth stocks. Top 75 names out of the growth portfolio are what you see on the screen now. Why do we want to talk about the earnings certain portfolio now? Because at the end of every earnings season, I love to see how these forecast estimates and the revisions coming in from the sell side are shaping up in aggregate. The earnings certain portfolio, remember, we had roughly 45 names in there that were subject to some sort of a reopening phenomenon, right? So you had companies like TJ Maxx, right? And you can see that here, right? We gave TJ Maxx a one-time pass. you can see that earnings trajectory is literally on course. Same thing with Ross Stores. I could go on and on. Starbucks, there's literally 45 of these names. So we give these guys a pass. You can see this tremendous recovery in earnings that's taken place. And that is why the earnings certain portfolio for 2021 is up 19% for 2021 and is going to moderate to 8% and 11%. Okay. Look at that nice smooth trajectory and the performance of the earnings certain portfolio. The average stock in the portfolio just continues to perform. Okay. Now, the Admiral portfolio, you're going to see that number come down, right? The Admiral portfolio is the portfolio where we stripped out the 45 names that were subject to some sort of a reopening phenomenon. And so that brought us down to the 30 names that will perform and even grow their forecast EPS trajectory during a U.S. economic shutdown. And for that matter, we could almost say a global economic shutdown during the COVID crisis. So you can see that we didn't have that 19% pop like we had for the Core 75 portfolio. The Admiral 30, rock solid 11, 8, 10% growth. And again, if you bring the valuation model up, I'll just go ahead and set this to default to align that normalized earnings trend line. Click on the least squares growth rate. You can see that over the past 20 years, this portfolio has just sustained underlying earnings growth on average of almost 12%. And you can see that we're more or less to trend here. I'm not going to save that. Okay. 11%, 8%, 10%. Again, these are the forecast estimates, right? When we take a look at the dividend portfolio performing equally as well. Keep in mind that with a higher yield, right, we're not reinvesting the capital back into these businesses, so the growth is obviously expected to be a little bit less. You can see 11%, 2%, 10%, but these are the top 25 yielding names out of the Core 75, and you can see that same trajectory, that protection from the downside that this family of portfolios offers. Is just tremendous. So all in all, for the earnings certain core portfolio family members, obviously I'm liking what I'm seeing coming through earnings season. We've got some issues in the payment space, Fiserv, global payments. I'm planning on commenting and doing a webinar on that entire space with PayPal and others. Next week, we'll talk about that. But I did want to mention the tilt portfolio as well very quickly. And we've seen this stair-step activity now since 2015. We get a ramp up, we get a cooling, we get a ramp up, we get a cooling, we get a ramp up. We're going to do a little bit of a cooling here, 45% to 11% to 24%. And this group just continues to deliver on their performance. And this is to be expected, still comfortable with the tilt, including Meta, the name change from Facebook, still delivering on growth. I want to thank you all for attending this week. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. If you're interested in getting started with Advisor Tools or ZRS, or if you're looking to upgrade your current subscription, please contact our world-class support at advisortools@zacks.com and ZRS@zacks.com. Thank you all for watching, and I'll talk to you next week.